Good afternoon, Crooker. Banu, Mary, Archana, Sai, Ashu. Good evening to all of you students. Let's start. So we'll start students with the non-resident taxation now. We are going to start students with the non-resident taxation. This would be the English Super 60 file which is already being shared with all of you. And students, what I have decided is that I will be doing with all of you Gayatri. But first, the discussion would be on the topics that we have already covered. So parallelly students, I will just try to cover up those topics also. So I am starting students in this particular case, Vasu, the NR taxation students. All of you will take up across the NR taxation. Now students, as far as the files are concerned, the NR taxation students starts off with the certain questions, but students, I will try to approach the question method in a very methodological manner. Now in this context students, the next particular aspect, the very important students, is about section number 9. So very quick recap students first I will do, and then I will take you through to the questions which have been introduced. So therefore with the concept I'm also going to solve with you those questions. Quick recap of the concept, and then thereafter students we are going to look into this particular areas of this one. Now students, section 9 definitely would be a very important particular part in this context. Section 9, as you all are aware, would be very important particular part which every one of you are aware of it. Now in the context of section number 9 students, always keep in mind in this case that if a very quick recap of the things which, if I may give it to all of you before we kickstart with the practical question, so that it facilitates you a proper understanding. But as far as section number 911, the first section, that is section 911, is concerned, section 911 is concerned. Yes, Vinod. If you see, there are two very important aspects which you all are aware, and one is that of the business connection, and another student is that of the indirect transfer. One of the two is very likely for your examination. Now, as you all are aware, students, business connection, if you all can see, it includes something and it excludes something. So there is an inclusion and then there is an exclusion, students. Students, inclusion has got two important particular aspects, and one is that of the dependent agent and another is that of the significant economic presence. One is that of dependent agent and another is that of the significant economic presence. This is how the non-resident under section 911, this is how students, the non-resident under section 911 will have its business income which will be deemed to accrue or rise in India, or there will be a case of an indirect transfer. The indirect transfer, students, will result into a capital gains income of the non-resident. Indirect transfer will result into a capital gains income of a non-resident. Now, students, over here, if you all will see very carefully, see what happens. The exclusion part, students, it is also very critical in this case. In all there is four specific exclusions and one general exclusion. You will say, sir, what are the four specific exclusions? The specific one which is there, students, is like this. Be careful now. The specific one exclusion which are there is something like this. In the context of the specific exclusion, students, in the context of the specific exclusion, what exactly you get it? That if the activity of the non-resident is confined to what? Is confined to, this is an important word, students. First is the purchase for export. Second one, students, if you see, the first one is purchase for the purpose of export. The second one, students, that you see over here in this case is shooting of cinema films, shooting of cinema films, shooting of cinema films. In this case, the third one, students, happens to be taking news from India for transmission outside India. Outside India. And the last exclusion, students, PJ, Umesh, something. The last exclusion, students, in this case is where the non-resident who is in the mining business, be careful, huh? Mining business, his activity, students, is confined to display of uncut diamond in the notified SEZ. Non-resident who is in the mining business, activities confined to display of uncut diamond in the notified SEZ. So these are the four specific exclusions to the definition of business connection. And because of this particular reason, students, the non-resident will not be having any business connection in India, and hence no business income will deem to accrue or rise in India. But be careful that the activity is confined only to this particular aspect. Only this item should be there. Beyond that, nothing else should be there. Beyond that, students, nothing else should be there. I hope that all of you are clear with this one. Beyond that, nothing should be there, students. If anything extra you do beyond these exclusion activity, if anything extra you do beyond this exclusion activity, then that extra will result into giving rise to that business connection to the non-resident in India. Giving rise to that business connection to in India. Gandhi. General exclusion, students. If the activity is only preparatory or auxiliary in nature, Meaning thereby, students, very much small activity, very much small activity. So if the activity is restricted only to preparatory or auxiliary in nature, meaning thereby very much small activity, then in that particular case also the non-resident will not be said to have any business connection in India. The non-resident will also be said to have no business connection in India in this particular case. I hope that all of you are clear with this one, every one of you, and that exactly is the point. That exactly is the point, students. So students, this is how the things has to be looked upon. Now, the this particular part, students, about the inclusion part in the dependent agent. Who is the dependent agent, students? Because this is very important part. So here, dependent agent means a person who wholly or mainly performs any one of the following activity on behalf of non-resident. Following activities on behalf of the non-resident. And what is that? Any one, student. The first one is the most important one, and that is what, students, the ICI is going to target in the examination. The first one happens to be the most important one, and that is what the ICI is going to target in the examination, students. So he's playing a principal role in this case. He's playing what? A principal role leading to what? Leading to the conclusion of the contract. Conclusion of the contract. So here, students, actual conclusion is irrelevant. Whether he is actually concluding the contract has got no relevance to decide whether through that particular dependent agent the non-resident will have a business connection in India or not. The actual conclusion of the contract by that dependent agent is irrelevant to decide whether that non-resident will what, students, will be said to have a business connection in India or not. So he should be playing a principal role which should lead to the conclusion of the contract, and only then we will say what, that the non-resident has a business connection in India. There are other particular points also, like now these are all independent activity, because any one of the following activity, so these are all independent activity in this case. These are all independent activity, students. Then in this particular case, in the second particular point, students, which has been there over here is this, that in the second particular point, students, which has been there over here is this, that what is the second particular point, students, in this context? That he is storing the storage of the goods. Storage of the goods. Whose goods, students? Non-resident goods. Now this storage of the goods, students, is for the purpose of the delivery. This storage of the goods, students, is what? Is for the purpose of the delivery. For the purpose of delivery. So here his activity is completely a new activity, a different activity as compared to the other one. So here, if supposingly you have got any person in India who either mainly or wholly on your behalf, what he does, he is storing the goods for the purpose of delivery as per your instruction, then also we can say that this non-resident through that dependent agent will have what, students, will have a business connection in India. Will have a business connection in India. I hope that all of you are clear with this one. Now this is what, should at least you remember these two particular points for the dependent agent test. At least these 2 points, students, you should remember it for the dependent agent test. But at the same time, I must tell to all of you that this is the inclusive definition. This is the inclusive definition. So if in the examination the ICI asks you a question wherein there is a person who is actually securing the contract of the non-resident, he is actually doing all what the agent does in India for the non-resident, then in any case, that is the general function of the agent. That is what? The general function of the agent. So although it may not have been defined, it is not required to be defined. Although it is not actually defined, but at the same time it is not required to be defined. Why? Because he is very much an agent, and if he is very much an agent, therefore in that case also the non-resident will have a business connection in India. In that case also the non-resident will have a business connection in India. The next point, students, is that of the significant economic presence. Now, significant economic presence, if you see, there are two particular aspects which you have to be very careful. In this particular case, students, supposingly the non-resident, they will give you in the question in the examination that the non-resident does not have any physical presence in India. The non-resident does not have any physical presence in India. So in that particular case, if the non-resident does not have any physical presence in India, but the non-resident, students, but the non-resident, students, he is supplying the goods to the person who is situated in India. He is supplying the goods to the person. Supply of the goods. Supply of the goods to whom? To person in India. To person in India is what is an important term that they have used. Not resident in India, but person in India. And students, what? And the minimum is, minimum, students, in this case, how much should be the minimum value? Should be more than rupees 2 crores. So the supply of the goods to the persons in India is more than 1 crore, 2 crores. And if that is the case, then yes, the non-resident, though he may not have a physical presence, but because of a significant economic presence, can we say that the non-resident has a business connection in India? Answer is yes. The non-resident has a business connection in India, and that exactly is the point. And the second one, students, in this case for the significant economic presence is the fact that the number of users who would be there in India, the number of users, students, you should be aware of it. The number of users who is there with whom he is interacting in India is how much, students? Minimum 3 lakhs. So the number of user test with whom the non-resident is interacting on electronic basis, how many number of user, students? Should be minimum 3 lakh. 3 lakhs. So this is minimum 3 lakhs. Whereas for the supply of the goods to the person in India, the value should be more than rupees 2 crores. So just be very careful on this two particular point. And yes, we can say that even because of this very reason, the non-resident will be said to have a significant economic presence. So though not any physical presence, but because of the significant economic presence, the non-resident will be said to have a business connection in India, and accordingly the income will be deemed to accrue as in India. The income will be deemed to accrue as in India, students. I hope that all of you are clear with this one. So this is primarily how you should be very careful, because I expect a question in the examination on this particular part. So this is what it is. Now last point, students, before we go to the next section, and after the next section, the practical question of Super 60. One very beautiful question is there, and that question could be in most probability should be there in your exam. I'll discuss that thing, but let me give you the last point in the business connection particular part. Students, in the business connection part, one important observation for all of you. Please pay attention. If supposedly they tell you about the agent, that there is an agent who in the ordinary course of his business, is independently buying and selling the goods from the non-resident. Independently. Meaning thereby, he is not wholly or mainly acting on behalf of non-resident. He is not wholly or mainly acting on behalf of non-resident. He is actually acting on his own account. So it may so happen that there is a particular agent in India who, along with this non-resident's goods or product, he is also supplying other people goods or product as well. He is also supplying other people goods or product as well. And the buyer who comes to his shop, that particular buyer decide as to which particular goods that he has to buy. So it could be the buyer's choice. So it implies that he is not pushing for any person's goods from his shop. It is up to the buyer to decide which goods that he needs to purchase. And if that is the kind of a function that this particular person is performing in India, then we cannot say that the non-resident has any business connection in India. We cannot say that the non-resident has any business connection in India, because this agent is acting in the independent course of his business. This agent is, students, acting in the independent course of his business and performing the function on his own account and not on behalf of the non-resident. And that exactly is the point, students. So this is all about 911. Chances are very high on this particular part, students, that the question can be targeted. The other particular part now, students, is about the income, like in the form of a salary income. Now, salary income, students, could be there, but the salary income, students, they may target the salary income in an indirect way. So let's have a look. When the salary income, primarily, there are two sections over here for the salary income. So the salary income, as we all know, will be deemed to accrue or rise in India to a non-resident employee, will be deemed to accrue or rise in India to a non-resident employee if the non-resident employee has rendered the services in India. If the non-resident employee has rendered these services in India, students. So if a non-resident employee has rendered the services in India, then we can say that this particular non-resident employee who has earned his salary for the period, which period? The period when he has served in India, then in that case, that portion of the salary is deemed to accrue rise in India. Apart from that portion of salary, students, there is further expansion to the scope. Apart from that particular period, there is a further expansion of the scope, and the expansion of the scope is in respect of, and the expansion of the scope, students, is in respect of particular if immediately before he joins in India for service, or immediately after he leaves India, after he leaves India, if he is taking any rest period or leave period, which is a paid leave, rest period or a leave period, which is a paid leave, immediately either before joining or immediately after joining. After he has served in India, he may take a leave, paid leave. Then even those period, whatever salary that he has earned for those period will also be deemed to accrue rise in India. Whatever is the salary that he has earned during those period will also be deemed to accrue rise in India, and that exactly is the point, students. I hope that all of you are clear with this one. Now, there is this particular case law, students, Eli Lilly Company Limited, that you have to be very careful of the Supreme Court, because this is how, yes, the example could be the sabbatical leave, but that should be immediately either before or immediately after. Immediately after, either before or immediately after, only then we can say that the condition is satisfied. Now, coming to this particular part of this case law, which is very important, and therefore, what is the situation? That there is a foreign company who is sending his employee to a client location. To the client location, the employee, students, were being sent. The employee were being sent, and thereafter, students, in this case, the client was being told that the client would be required to pay daily allowance to the employees of the foreign company who are put up in the client location in India. The client was being told that they would also be required to pay the daily allowances to the employee of the foreign company in India. So therefore, the question is whether this particular client who is making the payment of the daily allowance to the employee of the foreign company, whether this particular client will they be required to deduct the TDS under section 192? 192, that becomes the issue under consideration. Whether this particular client, students, whether this particular client in this case who is paying the daily allowance to the employee of the foreign company, whether this client will he be required to deduct the TDS under section 192? To that, students, the answer is yes, he will be. Yes, he will be required, students. And the reason for this is why 192? Because you may say, but sir, the client is not the employer in this case. Doesn't matter. Even though he is not an employer, that is not the criteria for deducting the TDS under 192. 192 says that the payer of the amount can be any person, students. Payer of the amount can be any person. That is the point. Okay, the payer could be any person. The payee could, in this case, the payee is, in this case, is an individual in this regard. So this individual primarily, in whose hands, students, this is the important test, in whose hand the sum so received, the sum so received, in whose hand, students, the sum so received is taxable under which head? Is taxable under the head, salary. Yes. So we have to only see whether in the hands of the payee individual, whether the sum which has been received by the payee individual, the recipient individual, whether the sum so received, is it taxable under the salary? If the answer is yes, it is taxable under the salary, students. In that particular case, what we are going to say, that the payer, who could be any person, will be required to deduct TDS under section 192. Will be required to deduct the TDS, students, under section 192. I hope that all of you are clear with this one now. Every one of you. And that exactly is the point. So therefore, in this case, yes, the employee of the foreign company, they are receiving the daily allowance in consequence of their employment with the foreign company. The employee who is receiving, the employee of the foreign company who is receiving the daily allowance, they are receiving the daily allowance in consequence of the employee of the foreign company, in consequence of the employee of the foreign company, and therefore what? Therefore the sum is chargeable in their hands under the head salary, and if the sum is chargeable in their hands under the head salary, then the payer of the amount, who is the payer of the amount? The foreign company. The payer of the amount will then be required to deduct the TDS under section 192. They will be required to deduct the TDS, students, under section 192 in this case. I hope that all of you are clear with this one. So this is one of the point which has been there, which you have to be very careful about it so far as this particular part is concerned. Rest of the things are fine. Apart from that, students, there is one more particular point of 913. Quickly, if you can recall, in 913 what they have said, that if supposedly a government of India is paying to their, to whom? To their citizen. They are paying to their citizen who are there outside India the salary, then the salary which is paid by government of India to their citizen outside India, then even that salary which is received by the citizen is deemed to accrue or rise in India. That particular salary which is received by the citizen from the government, that salary is also deemed to accrue or rise in India. Also, students, one important exemption is there over here, and the exemption is that if supposedly the government is paying any allowances or perquisite to the citizen outside India, then the allowance and perquisite which is paid by the government to the citizen outside India will be eligible for a full exemption on that. Will be eligible for a full exemption, students, in that case. So just keep that particular point in mind. Keep that particular point in mind, students. I hope that all of you are clear with this one. Every one of you. And that exactly is the point, students. Exactly is the point, students. So this is what it is in this regard. Now, students, in this context, one last particular MCQ based question was targeted by the ICI, which I just want to very quickly discuss with all of you. One last MCQ based question that was being targeted was this. The question that they have targeted, students, was this, that whether a particular non-resident, students, employee in India who is receiving what? Who is receiving the salary from, who is receiving what, students? The salary from the foreign citizen. Who is receiving the salary, students, from the foreign government. So if the foreign government is giving the salary to their citizen in India, students, in that particular case, even that salary income earned by the employees employees of the foreign government who are not a citizen of India, students, be careful. The only condition that needs to be seen is that they should not be a citizen of India. And if they are not a citizen of India, then the exemption under section 10(7) will be allowed. then the exemption, students, under section 10(7), will that be allowed? To that the answer is yes, it will be. To that the answer, yes, it will be, students. And that exactly is the point, students. That exactly is the point, students. So this is what it is. Now in the MCQ question, students, they have said that this citizen was actually an Indian citizen who was posted in the embassy of the foreign government. Who was posted in the embassy of the foreign government. That if an Indian citizen who is posted in the embassy of the foreign government, if they are receiving the salary, from the foreign government, in that particular case, whether the exemption, students, will it be allowed in this particular case? Whether the exemption, students, will it be allowed in this case? Answer is no, because he is a citizen of India. The exemption is only if that individual employee is not a citizen of India and he is receiving salary from the foreign government. Only then the exemption will be allowed. Only then the exemption will be allowed, students, and that is the criteria. MCQ question is there probably of the ICI. So that is it, students. And then thereafter, students, comes your next particular proposition. And what is that? Section 914, which is in respect of the dividend income. Dividend income, students, is a simple one. Only one thing that you need to remember is that if a non-resident or a foreign company is receiving the dividend from an Indian company, if a non-resident or a foreign company, if they are receiving the dividend from whom? From an Indian company, then the dividend so received outside India will also be deemed to accrue as in India. The dividend so received outside India will also be deemed to accrue as in India, and that is what section 914 is all about in this case. That is what section 914 is all about in this case, and that exactly is the point, students. Okay, now we come to the next three section, and based on that there is a very important particular question, and this could be one of the expected questions so far as your examinations is concerned. And that is, students, the three next sections are very critical, and those three sections, students, is under section 9, is that is interest, royalty and the FTS. And based on that we will then pull up this particular case study as well. So students, interest, royalty and FTS income of a non-resident. Interest, royalty and FTS income of whom? Income. Whose income? Non-resident income. So this interest, royalty and FTS income of the non-resident. So when this is deemed to have accrued in India, deemed accrual is the first particular point to be considered. So students, the deemed accrual will depend upon who is the payer of the amount. Who is the payer of the amount? So if the payer of the amount, students, happens to be the government of India, if they are the payer, then this three income, which three income? Interest, royalty and FTS would always be deemed to have accrued in India. Always be deemed to accrue in India, students. If their payer is, who are the payer? The payer happens to be the government of India. But if deemed to accrue in India, this is what you will say. Deemed to accrue in India. But if you say, no sir, the payer is not the government of India, but the payer is the resident who is paying to another non-resident or foreign company, or the payer also can be a non-resident himself who is making the payment to another non-resident or to the foreign company. And what is the nature of payment? The nature of payment, students, happens to be interest, royalty or FTS. The nature of payment happens to be interest, royalty and FTS. In that particular case, students, in that particular case, the deemed accrual of these three income will take place. The deemed accrual of these three income in India will take place only if the deemed accrual in India will take place only if, students, only if the payment, these payment are in respect of the business or a source which is situated in India. Are in respect of what? The business or the source which is situated in India. So the payer who is making the payment of interest, royalty and FTS, to whom he is making the payment? To another non-resident. Who is the payer, by the way? Resident, or the payer also can be a non-resident or a foreign company. And to whom they are making a payment? Who is the payee? Payee is a non-resident of foreign company. So then, in the hands of the recipient who is receiving interest, royalty and FTS, these three income will be deemed to accrue as in India if the payment which is made by the payer is in respect of their business or their source which is situated in India. In respect of their business or the source, their business or their source which is situated where? In India. Only then the deemed accrual will take place. Is situated in India, students. And that exactly is the point, students. That exactly is the point. And this is how the things has to be considered over here, students. I hope that all of you are clear with this one in this context. So the deemed accrual, students, will be because of this particular reason, students, and that exactly is the point. That exactly is the point, students. I hope that this particular point is well taken by all of you, every one of you, students. So this is what it is. So this is for the resident or non-resident. This is for a resident or a non-resident, students, in this particular context. Now, students, one important particular proposition which has been there over here. Okay, so deemed accrual is there. One very popular question which they target in the examination, students. Very, very popular question, students, that they're targeting in the examination is this, that there is, students, tell me one thing. In this entire case, do we see the location of the recipient non-resident, the payee non-resident, whether he has actually performed the services in India? Is that criteria relevant criteria to decide whether the income will it be deemed to accrue rise in India? Whether that criteria will it be considered to be a relevant criteria to decide whether the income which is interest, royalty or FTS will it be deemed to accrue rise in India? Answer is no. That criteria, students, will not be considered to be the relevant criteria to decide whether the income will be deemed to accrue rise in India. I hope that this point is very clear to all of you. So whether he actually has performed the service in India has got no relevance. What is only relevant to be seen for the purpose of deemed accrual, that if the payer is a resident or if the payer is a non-resident, then these payers should be making the payment in respect of their business or a source which is situated in India. Then irrespective of where the non-resident has actually performed the services, irrespective of where the non-resident, from which location he has actually performed the services, the income still will be deemed to accrue rise in India. The income still will be deemed to accrue rise in India for the non-resident recipient. Receiving what? Receiving what? Interest, royalty or FTS income. The second irrelevant criteria. The second irrelevant criteria. Do we have to see whether the non-resident recipient who is receiving interest, royalty and FTS, that whether this non-resident recipient, do they have any business connection in India? Is that a criteria to be seen when we are deciding the deemed accrual under 915, 916 and 917? Whether these criteria are they relevant? Again, the answer is no. These criteria are irrelevant, students. These criteria are irrelevant in this case. That whether he has got any office, whether he has got what? Any office, particular location, any office business connection in India, that becomes an irrelevant criteria. And the third irrelevant criteria is that whether that non-resident, does he have any physical presence or a place of business or any place of residence in India. Even that is irrelevant criteria to decide the deemed accrual of what? Of interest income, royalty income and FTS income of non-resident. So the deemed accrual is tested only on the basis of who is the payer, number one. And if the payer, if it is the government of India, always deemed to have accrued in India. If the payer is whom? The resident or a non-resident. If the payer, students, is whom? Resident or a non-resident, then in that particular case, the deemed income, students, in this particular case, the deemed accrual, students, is because of this reason. That is, the payer who is a resident or a non-resident, the payer who is a resident or a non-resident, payer who is a resident or a non-resident, probably he is making the payment in respect of their business or a source which is situated in India. Is that point clear to all of you? Now, students, the second point over here is the characterization of payment. How this particular payment will it be characterized? I will come to the characterization part, because one of the important case law which is there in your RTP, which is also there in your judicial updates, and actually they have drafted a beautiful question in the last attempt RTP is what I have captured in your Super 60 question. Beautiful question. One is in the form of an MCQ and another is in the form of a case study. I feel the MCQ could be targeted, but nevertheless it is ICI. Both the questions are of the RTP. That we will see. That we will see, students, in this context. In this regard. So students, in this particular context, students, just hold on. Just a second. Students, this questions will do at 7:30 in the evening, students. An emergency has turned up right now. 7:30 p.m. students in the evening. I'll start with 7:30, primarily 7:30 to 9 p.m. So we will be taking across this question in this case on the NR taxation on the Super 60 in this context 7:30 to 9. I will tell again we'll share the link with all of you students and I'll tell the ma'am to share the link. Okay, it could also be recorded lecture, so those who could not make it they can easily see it later also. Absolutely fine, students. Just excuse me on this particular proposition, students. Here it. I'll share the link. I'll tell ma'am also to share the link, students, over here. And those who could not make it, the recorded also would be done. 7:30 to 9, we will be taking across the question, students. We will be taking across the question in this case. Okay. So just students in this particular context. 7:30.
कर दिया स्टार्ट कर दिया मैंने दोनों
बस श्रीतमा को बोल देना कि मैं न्यू वीडियो को अपलोड कर रहा हूँ. ये मुझे लगता है कि बीच में आ रहेगा और लास्ट में आ रहेगा, ऐसी कुछ हुआ रहेगा. एक बार देख लेना और एक बार उसको ना ये 4 वीडियो को एक बार घुमा देना कि क्या है लास्ट में हुआ रहेगा ये इशू. और देखना एकदम स्टार्टिंग में कुछ मैंने कुछ ऐसे बोला रहेगा, जैसे बीच में देखना तो आइडिया लग जाएगा कि ये चीज़ आई है. नहीं श्रीतमा को बोल देना अपना मनोज ये सिचुएशन. Ma'am, one link for RRC, ma'am, 7:30 today would be required, ma'am. 1.5 hours to 2 hours I'll be taking as an extension of the right now lecture.
आपने जिस व्यक्ति को कॉल किया है वो अभी दूसरे कॉल पर व्यस्त है. कृपया प्रतीक्षा करें या कुछ समय पश्चात प्रयास करें. The person you have called is speaking to someone else. You can wait or call again later. आपने जिस व्यक्ति को कॉल किया है वो अभी दूसरे कॉल पर व्यस्त है. कृपया प्रतीक्षा करें या कुछ समय पश्चात प्रयास करें. The person आप जिस व्यक्ति को कॉल कर रहे हैं वह
Sir?
Yeah, ma'am.
Sir?
Yeah, please say, ma'am.
You want help, sir?
Yeah.
Sir?
Yeah, please go
I
ahead, ma'am.
make you as a host, sir. You can
Okay.
record the session, sir, on your system.
Okay.
I'm not able to record the session,
Okay, I'll
sir.
do that. I'll do that, ma'am. So students, in this particular context, herein,
Yes, sir. You please
Yeah,
click
yeah.
on the.
deemed
Sir,
accrual.
can you hear me?
Yeah, recording
Sir?
on. Yeah, recording, ma'am. Recording, ma'am.
Sir, there is a dot, right, sir? You please click on that.
So now, students, in this particular context, the discussion that we already had about this particular part was about the fact that in the last particular part, students, the discussion that we all had was in respect of the taxation of the royalty and the FTA, students, in this particular context. And in this particular scenario, students, if you all would have appreciated this particular part, which was the fact that the deemed accrual will take place on the basis of the location, who is the payer of that particular amount. And on that basis, students, we have finally concluded as to where the deemed accrual of the royalty or the FTS income will take place, or even the interest income. So that part is over. The second part, students, is about the characterization of the amount. When I say characterization of the amount, means therefore that when this particular income which has been paid to the non-resident, that particular amount could be considered as interest, royalty or FTS. That happens to be the second particular part. This particular part also we will look into it carefully. Okay, in this case law, this particular part is going to come. But the third part, students, is all about the assessment part. Now, students, as far as assessment is concerned, one thing is should be very clear to all of you now in this particular context, that how to do the assessment of the interest, royalty and the FTS income. There is a special rate of tax which is applicable primarily in the case of royalty, interest and the FTS income of the non-resident. This special rate of tax, students, was not there. This special rate of tax was not there in the case of business connection part that we have discussed in the previous session. Salary also, we have seen, for the salary income also there is no special rate which is there. So whatever is the normal rate as it is applicable, the same would also apply over here. The special rate of tax therefore is applicable in the following income, namely the dividend income, which we have discussed. When it is deemed to have accrued to the non-resident, the dividend income is deemed to have accrued to the non-resident only if the payment of the dividend is made from an Indian company. In that particular case, the dividend income of the non-resident or of the foreign company will be deemed to have accrued or rise in India. Now, for dividend income, there is a special rate of tax. So, special rate of tax which has been there in this context, that we look upon to this particular part. The special rate of tax in this context, students, is, as I told you, herein. In this context, students, it is for the dividend. Section is 115A. The rate is 20% flat. The rate is 20% flat. This I'm talking about the dividend income. As far as the interest, royalty and the FTS is concerned, interest, royalty and FTS is concerned, For them, then what is the proposition? Let's look upon to first the interest income. Now, interest income, students, there is multiple rates which are being there. One is the case of 5% or 4%. Now, this case of 5% and 4% rate of interest, or the tax rate for interest income, is applicable. The 5% or the 4% family rate of tax is applicable when the interest income is from the long-term infrastructure bonds. The second one, students, is about what? Is in the case of the interest received from the rupee denominated bond, students. Rupee denominated bond, students, in this particular case. The third one is when the interest is received from the REIT. So these are the three particular cases where the tax rate on the interest income happens to be 5%. That is the case. So that will be the tax rate. And the 4% would be applicable if these particular securities are listed in the recognized stock exchange which is located in the IFSC. The recognized stock exchange which is located where? In the IFSC. At that particular point of time, the tax rate on the interest income will be at 4%. Would be at 4%, students. So that is rate number one. Now the second particular case, students, which is there for the interest particular part is 20%. Now please understand, these two particular cases is when primarily these are the rate of tax which is there in section 115A. Under section 115A, the second rate is, as I told you, is 20%. The 20% would be there when the debt is raised in foreign currency. So if the debt has been raised in the foreign currency, in that particular case, the interest income arising from that particular debt or loan or the borrowings will be taxed at the rate of 20%. And again, that is under section 115A. That is, students, also under section 115A. So this is also the second rate of tax which is there in this particular context. Now, apart from that, students, there is one very important adjustment which keeps coming up again and again, and that is about the case where the debentures has been issued by an Indian company. The debentures has been issued by an Indian company. In that particular case, the debentures has been issued by an Indian company, students. In that particular case, the debentures definitely would have been issued in INR. Since it is issued by an Indian company, it will be issued in INR, and therefore on that debenture, the interest income which is earned, the interest income, students, which has been earned in this context, that interest income will be taxed. That interest income, students, will be taxed at what rate? That interest income, students, will be taxed at the rate of normal rate applicable to that non-resident or the foreign company. The normal rate of tax which is applicable in the hands of the non-resident or the foreign company, as the case may be. I hope that all of you are clear on this one in this context. So this is how the things has to be looked upon. So just keep that particular point in mind, that the interest income which is there of the non-resident, that interest income of the non-resident, if it is out of a borrowing or a debt which is in the Indian currency, then in that case the interest income will be taxed at the normal rate which is applicable to that particular non-resident or a foreign company. If it is a foreign company, we all know it is 40% rate of tax. Whereas if it is, students, whereas if it is an Indian company, whereas, students, if it is, sorry, say an individual, whereas if it is an individual, then the rate of tax which would be applicable would be the rate applicable to a particular individual or the HUF. The rate which is applicable to the individual and the HUF. And that exactly is the point. That exactly is the point, students. So this is how the things has to be looked upon. So students, this is how the things has to be considered in this regard, in this particular context. Okay. So this is what it is. Now, students, apart from that, there is also the case wherein there is a 10% rate of tax which is applicable. 10% rate of tax which is applicable. Now that is a very special case. If the question will come, then I will definitely will let you know. on that 10% rate of tax, there is a one very peculiar case in which the tax rate for the interest income will be 10%. 99% cases, students, your question would be only on these two rates, which is 5% or 20% as the case may be. 10% in one particular case only, 10% only in one case, that the rate of tax which is applicable on the interest income. So this is one thing which I just will let you know, but just I'm making you right so that the point when it comes, I'll let you know about the same. Royalty and FTS, students, as it goes for the royalty and FTS taxation, it all depends on one very important question, and the question is, students, whether the non-resident is having the non-resident or the foreign company who has earned the royalty and the FTS income, whether these non-resident are having a permanent establishment in India, and whether through that permanent establishment in India, whether they have provided the services and because of which they are earning royalty and interest income or royalty and FTS income. If the answer is yes, students, so that P factor, the P factor means the presence of P and the services rendered through the P, the presence of P in India and the services which are rendered through the P in India. If the P factor condition is satisfied, then the assessment of the royalty and FTS income, students, will go on net basis. When I say net basis, students, it implies that the deduction would be available in respect of the expenditure or the allowances. The deduction will be available in respect of the expenditure or the allowances, and that is the reason why this particular royalty in the FTS will be assessed on net basis. Whenever there is 115A or whenever there is a special rate of tax which is applicable, students, whenever there is 115A or whenever there is a special rate of tax that is applicable, always keep that point in mind, that no deduction of any expenditure, loss or allowance is available from that particular income which is taxed at the special rate. So therefore, if the P condition is satisfied in the case of the royalty and the FTS income, then what we say is that then the assessment of that royalty and the FTS income will be on net basis, which means that all the deduction of the expenditure, loss or allowance which are wholly and exclusively pertaining to that particular P will be allowed as deduction. Students. And therefore, on that particular net amount, primarily the tax rate, as you can see, what would be the tax rate? The applicable tax rate. Now, whenever I say applicable tax rate, it implies what? If you are a student on a foreign company, then the applicable tax rate is 40%. Whereas if you are an individual or the HUF, then the applicable rate of tax is a slab rate. But if the P condition is not satisfied, students, is not satisfied in that particular case, what happens over here is that the assessment will then go under section 115A. And if the assessment goes under 115A, the rate of tax that is applicable would be at 10%, students. The 10% would be the rate of tax. And as I told you, because it is a 10% rate of tax, which is a special rate of tax, and that is accessible under 115A. Therefore, whether there would be any case of a deduction of expenditure, loss or allowance from this particular royalty and the FTS income, answer is no. Students. So I hope that all of you are clear with this one. Now, students, there is one very important particular concept which has been there. Now, here is the question which we are now going to discuss. This particular question, students, is that of an equalization levy also. This particular question, students, is also that of the equalization levy, which we are now going to look upon to this particular proposition. Students, just very quickly, I will first let you know about this concept, because why such a beautiful case study the ICI has put up, students. Here we need to go to equalization levy because there is some sort of a linkage of royalty and FTS against the equalization levy. What is that linkage? I'll let you know. But before the linkage part of royalty and FTS with the equalization levy, please pay attention to this particular proposition. All of you, please pay attention. Students, in this case, as you all know, equalization levy are covered in two sections. And those two sections, students, are section 165 and another is section 165A. So two sections covers students equalization levy. One is section 165, another is 165A. So far as section 165 is concerned, students, the service provider in 165 happens to be a non-resident. That non-resident who does not have any pay in India. That non-resident who does not have any permanent establishment in India. The service recipient in this case should be either a resident, who has a business and profession, and if the service recipient, if he is a non-resident, then that non-resident service recipient should have a permanent establishment in India. Then that non-resident service recipient should have a non-resident service recipient should have a permanent establishment in India. Now, what is the nature of service which has been provided by this non-resident to the service recipient? The nature of the services which has been provided is that of the advertisement service, or providing the space for advertisement, as the case may be. The online advertisement or providing the online space for advertisement, that is the nature of service which has been provided by this non-resident. If this condition is satisfied, then in that case, the section 165 says that the service recipient would come under the obligation that on the payment of the consideration, which should exceed more than rupees 1 lakh, on the payment of that consideration, students, what happens? 6% of the equalization levy, is what will be deductible. 6% of the equalization levy, students, is what will be deducted. So if I am paying the consideration of 100, equalization levy of 6% is what will be reduced from that consideration amount, and the net is what would be paid, and the net amount is what, students, would be paid. The 6% which I have deducted as an equalization levy, that amount I need to deposit, students. That amount I need to deposit primarily by when I need to deposit? By 7th of next month. Students, it's a monthly payment which the service recipient will have to do. And by 7th of next month, students, that particular equalization levy so deducted has to be deposited. That 6% of the equalization levy amount is what needs to be deposited by 7th of next month. Students. Okay. Now, please be careful on this particular part. In this case. Now, in this particular context, students, the real particular proposition goes like this. Okay, by the way, students, every month primarily he will make the payment by 7th of next month. Every month, students, he will make the payment by 7th of next month. What about the month of December? What about the month of March? For the month of March, by when the payment will have to be made? For the month of March also, students, the payment has to be made by 7th of April. By 7th of April, students. So that is the protocol, students, which is there to be followed in this regard. That is a protocol, students, that has to be followed in this regard. Is that point clear to all of you? Now, if there is a failure to make the payment, students, then in that particular case, if there is a failure to make the payment within the due date, then 1% would be the interest that would be applicable. In this regard, and that is for per month or part thereof. Apart from the interest, students, there would also be a penalty, and the penalty would be if you have failed to deduct the equalization levy, then 100% is the amount of penalty. But if you have failed to make the payment, but you have deducted, in that case, the amount of penalty is 100 rupees per day. 100 rupees per day is the amount of penalty that you have to pay in this regard. Okay, so these are the consequences primarily of failure to deduct the equalization levy, and after deducting, if there is a failure to pay the equalization levy. Now, one important point, students, supposingly the service recipient has failed to deduct the equalization levy. In that particular case, students, what will happen? Then the service recipient, for him it is an expenditure. because that they are paying the consideration. For them it is an expenditure, so that expenditure will be fully disallowed. That expenditure will be fully disallowed. What if the equalization levy is subsequently deposited to the government? What if the equalization levy is subsequently deposited? Then in that particular case, students, the amount, if it is deposited subsequently, then you can definitely claim the amount of deduction in respect of the expenditure that you have paid. So this is all about the provision as far as section 165 is concerned. Service provider non-resident without a PE, service recipient is a resident with business and profession, or service recipient can also be a non-resident but with PE. The nature of service which is provided is online advertisement or providing online space for advertisement. And on that, if the consideration amount in aggregate exceed rupees 1 lakh, then the service recipient at 6% will be required to deduct the equalization levy, and the amount so deducted will have to be deposited by 7th of next month. Going to the next particular equalization levy of section 165A. In that equalization levy of section 165A, students, the service provider happens to be whom? The non-resident, who is referred as an e-commerce operator. In the case of section 165A, always remember them as an Amazon. Always remember, students, the e-commerce operator as an Amazon. So the service provider is a non-resident, but that non-resident who does not have a PE, and thereby this particular non-resident has provided a particular for the specified activity of the non-resident, and to whom they have provided this particular who is the service recipient for this activity. The service recipient can be a resident. Now here for 165A, resident could be anyone, need not necessarily be for business and profession. Unlike in the case of 165, wherein the resident necessarily has to be for the purpose of business and profession, here the resident could be anyone. It could be like even you people who could be a resident, and who could be a resident service recipient. Apart from that, they have also said that any person, service recipient can also be any person who have taken this activity, who has availed the activity of the service provider through the website which is registered in India. And therefore, if I tell to all of you that supposingly if a particular US based citizen who is there in US and he has logged in to www.amazon.in, logged in where? www.amazon.in and not in www.amazon.com. So if he has logged into www.amazon.in, in that particular case, it means that this is the website or internal IP address which is registered in India. And because this is an IP address which is registered in India, therefore in respect of this particular activity also, the equalization levy under section 165A will be applicable. The equalization levy under section 165A would also be applicable. And the third category, students, the third category in this particular case is when the service recipient is a non-resident. The third category of service recipient is that of a non-resident, but that non-resident in specified circumstances. What is it, specified circumstances? We'll discuss a bit later. One more point, students, which is there over here is that the equalization levy under 165A is applicable on the service provider. Students, on the service provider, that is on the e-commerce operator. So unlike in the case of 165 where the equalization levy used to be deducted by the service recipient, here in the case of 165A, the service provider is going to pay the equalization levy on the consideration amount that they have received. The equalization levy would be paid on the consideration amount. And how much is the equalization levy that they have to pay on the consideration amount? 2%. 2% of the consideration amount, that will be the amount of the equalization levy. 2% of the consideration amount, that would be the amount of the equalization levy which the service provider or the e-commerce operator has to pay. This particular payment, students, would be made by the e-commerce operator on a quarterly basis, not on monthly basis. So here in case of 165A, the equalization levy has to be paid or deposited on a quarterly basis. And for every particular quarter, the 7th of next month following the relevant quarter, the 7th of next month following the relevant quarter becomes the due date of the payment of the equalization levy. The 7th of next month following the relevant quarter becomes the due date of payment of the equalization levy. However, in the case of the last quarter, it is students 31st of March. In the case of last quarter, students, it is 31st of March. Now, in this case, if supposingly there is a failure on the part of the e-commerce operator to pay the equalization levy, please understand here there is nothing of deducting the equalization levy, unlike in the case of section 165. 165A is required for payment of equalization levy. So if there is any failure on the part of the e-commerce operator to pay the equalization levy, then in that particular case, students, what we will say? We will say that the interest same at the rate of 1% per month or part thereof will be charged, and the penalty would be 100%. Penalty would be 100%. Why 100%? Because in the case of 165, there were two obligations, one to deduct and another to pay. One to deduct and another to pay. If there is a failure to deduct, then 100%. But after deduction, if there is a failure to pay, 100 rupees per day penalty was there. But here the liability to deduct is not there, because it is an e-commerce operator who is receiving the consideration. That e-commerce operator himself has to pay the equalization levy at the rate of 2% on the consideration amount which has been received. On the consideration amount, students, which has been received, and therefore if there is a failure to pay the equalization levy, then the penalty that would be applicable would be how much, students? 100%. Would be how much, students? 100%. And that exactly is the point. Now, in one particular case, the e-commerce operator will not have any liability towards the payment of equalization levy, and that particular case happens to be, students, you may be aware of that, when the total turnover or the gross receipt of the relevant previous year, say for example previous year 22-23, if the total turnover or the gross receipt, if it is less than 2 crores, if that particular turnover, if that is less than 2 crores, then no equalization levy will be paid by the e-commerce operator. That does not mean that the service recipient will then be liable to pay or deduct the equalization levy. No such liability would be there. Actually, the equalization levy of 165A in that particular case will not apply if the e-commerce operator has a turnover which is less than rupees 2 crores. And students, is there any monetary threshold which is applicable for equalization levy under 165A? Is there any monetary threshold that is applicable for equalization levy under section 165A? To that the answer is no. So even if the consideration amount is, say, as low as 50,000 rupees, on that 50,000 rupees, the e-commerce operator will be required to pay the equalization levy at the rate of 2%. But the only particular criteria which I have told to all of you, so far as the payment of equalization levy obligation will arise, the only criteria of obligation for equalization levy will arise only if the e-commerce operator turnover is either 2 crores or more than 2 crores in the relevant previous year. Students. I hope that all of you are clear with this particular proposition. If that be the case, students, let me now come to this royalty and FTS and this particular equalization levy factor. Be careful, students. Be very careful. Students, both 165 and 165A says that no equalization levy if the consideration students is characterized as royalty and FTS under section 115A, which means on that there is a rate of tax of 10%, which means the rate of tax, students, is 10%. No equalization levy if the consideration is characterized as royalty and FTS under section 115A, which means that on that the rate of tax, students, is how much? 10%. 10% is the rate of tax, students. I hope that all of you are clear with this one. Why is it so that the government wants to exclude such consideration which can be characterized as royalty and FTS? Such consideration which can be characterized as royalty and FTS from the ambit of equalization levy? Reason is very simple. See the rate of tax. If it is an equalization levy, how much you can collect? 6%. In the case of 165 and 165A, it is 2%. And on the consideration amount, here also, because you don't get any deduction if it is characterized as royalty and FTS and it is assessable under 115A, the fact that you don't get any deduction of an expenditure, the fact that you don't get any deduction of the expenditure, students, in that particular case, what happens? The fact that, students, you don't get any deduction of an expenditure, in that particular case, what we say? We say that the equalization levy, students, primarily is if you say there is no deduction of any expenditure, so the tax under 115A is also on gross basis, that is on the consideration amount. And because the rate of tax under 115A of 10% is higher as compared to the equalization levy of 165, which is at 6%, or equalization levy of 165A, which is at 2%, therefore the exclusion that they have done. Therefore, the exclusion, students, that they have done. So therefore, one may argue, sir, under what case, students, there could be a possibility that the consideration could be characterized as a royalty and FTS, which otherwise could have been characterized as a royalty and FTS. Means royalty and FTS, you are saying it is a royalty and FTS, but equalization levy is also applicable. Which is that particular example? So example is this case study which the ICA has given to all of you. Students, let me first take you through to 165A, the nature of activity on which 165A equalization levy is applicable. Just, students, recall the e-commerce operator who is there. He is maintaining a website. The e-commerce operator, students, who is there, he is maintaining a website, and through that particular website, students, he is providing the following activity. Activity number 1, he is directly selling his goods or he is directly selling his services. That is point number 1. Or activity number 2 is where he is facilitating, where he is doing what? Where he is facilitating the sale or the provision of goods or services of e-commerce participant, where he is facilitating the sale or the provision of the goods or services of the e-commerce participant. In that case also, students, the equalization levy under section 165A is applicable. So where exactly is the common ground for royalty and FTS vis-a-vis the equalization levy of 165A, where we say that whenever there is a common ground, then in that case there will not be any equalization levy, but the tax will be charged under 115A, and that too at the rate of 10% on a gross basis. Which is the common ground? Students, all of you will pay attention to this particular case study, the case law which is there in the judiciary also of your ICI judicial updates, as well as in the various RTPs and the MTPs. This case study has been put up. So in that context, students, if you see very carefully, it is in the case of the computer software. Students, computer software, when we talk about it, there are two types of computer software. One computer software, students, is a customized software, and another is the standardized software. A standardized software. Customized software is like a ERP and the SAP, which is customized to the solution or the need of a particular company. Whereas a standardized software is a standardized for all, like for example, Microsoft operating system. Now, Microsoft operating system or many such like anti-Norton and this Norton antivirus software, or even the Tally software, which is also a case of a a standardized software, because whether it runs in my PC or whether it runs in your PC, the output will be the same. And therefore, students, in this particular case, when it comes to the case for the computer software, students, whenever it comes to the case of a computer software, what is the proposition, students? Then be careful, students. See, one thing is there. I always give this example, always keep this simple example in your mind. Like I'm making a book. If I'm making a book So which is going to be published by, say, Bharat Law House. Book would be made by me and that will be published by Bharat Law House. So what I will do first, I will transfer my copyright. I will transfer my copyright completely. So there is a transfer of the copyright from my side primarily to Bharat Law House. Once the copyright itself is transferred, then what happens? Bharat Law House, based on that copyright which has been transferred to them, they are going to exploit the copyright. And from the exploitation of copyright, they will be making the copyrighted article, which is the books, textbooks. And that is a textbook which is a standardized copyrighted article. That is a textbook which is a standardized copyrighted article, is what will be sold across the country. So students, Bharat Law House has paid me a consideration. The consideration which Bharat Law House is paying it to me, definitely that consideration, will it be considered as a royalty income in my hands? Answer is yes. The consideration which Bharat Law House is paying it to me, that would be considered as a case of, sorry, that would be considered as a royalty income because it's about the transfer of copyright. But the consideration that you people are paying it to Bharat Law House, the consideration that you people are paying it to Bharat Law House, whether that also would be considered as royalty paid by you to Bharat Law House? Answer is no. That is not a case of a royalty. That would be a case of the payment towards. That would be the case for the payment towards what? Sale of goods. It is like a good, students, which has been there, isn't it? So similarly, a standardized computer software is also like a goods. Why? Because the definition of goods, what is the definition of goods, by the way? The definition of goods is something which is marketable. Something which is marketable means which has a capability of being sold as such in the market will be considered as a goods. And therefore, students, in this particular case, the what you people are paying it to Bharat Law House is towards the sale of goods, because it is a standardized article capable of being sold, and hence payment towards the goods. And accordingly, if it is a payment towards the goods, is it a payment for royalty? Answer is no. Same way, students, whenever a standardized software is being sold, again it has that particular characteristic of marketability. It has that characteristic of marketability, and because it has the characteristics of marketability, therefore the payment which we are paying for the standardized computer software, that also should be considered as a payment for goods. That also should be considered as a payment for goods. However, what? However, primarily the Indian Income Tax Act says that it is what? It is a royalty income. That even if it is a payment towards a standardized copyrighted standardized computer software which is a copyrighted article, standardized computer software which is a copyrighted article, the Income Tax Act defines the royalty to even includes the consideration towards the payment for the standardized computer software article. The payment towards the standardized computer software article, even that has been defined under the income tax law as a payment for royalty, which means that this amount, will it be charged to tax under the Income Tax Act? Answer is yes. But in that case, even this income which is received by the non-resident, or say Microsoft, that income will be taxable in their home country also, which is US. So what happens in this case? It will become a double taxation. And if it becomes a double taxation, we may have to refer the treaty. And whenever we will have to refer the treaty, students, even the treaty will provide the definition of royalty. Even the treaty will provide a definition for royalty. And if the definition of royalty in the treaty does not include the payment for the transfer of the copyrighted article, if the treaty in its definition of royalty does not consider the payment towards the copyrighted article as a royalty income, then in that case, students, it cannot be then taxed as a royalty, and therefore as per the treaty it cannot be taxed as a royalty. And if treaty says it cannot be taxed as per royalty, then definitely the treaty is more beneficial. The treaty is more beneficial, and if treaty is more beneficial, students, in that case, even under the Income Tax Act, it cannot be taxed as a royalty income. Even under the Income Tax Act, it cannot be then taxed as a royalty income, meaning thereby because the treaty is more beneficial as compared to the Income Tax Act. On this backdrop, students, question number 35. All of you, students, first of all, I just want all of you to read it once. Students, just quickly read through this particular case study. This is such an important case study, could be there in your exam. We have to solve this particular question. So please get started with this. All of you have read it, students. So you can see over here that this particular SSC Flip Inc. A country X company maintains an online web platform through which it provides the end user computer software, which is through the licensed software, meaning thereby there he is maintaining the platform and I need to log in by, say for example, using my the user information and the password, and then thereafter I can then use that particular web-based platform for my computer solutions. And this is a licensed platform, which means that I'm giving the license to use. So that license has been given to me is only a limited license, which is only to use. Is the license given to me that I can produce n number of copies of that platform and then make a platform on my own and then thereafter start providing the services to others? Answer is no. That is only a user license and nothing else. But what is the license which I gave to Bharat Law House, for which Bharat Law House paid me the copyright? For which the Bharat Law House paid me the copyright? The license which I gave was the transfer of a copyright, and thereby Bharat Law House gained the right to exploit that copyright and then make n number of copies and sell it in the market. But what about in your case, students? You also are getting the same particular license from Bharat Law House, that you also start making the book out of the book which you have got it and start selling in the market. That is not license which you have got. You have got the license only to use. So that is known as what? The end user license agreement. So that is what it is. Next is MNO Limited. MNO Limited, an Indian company, has entered into a contract for 5.7 crores with Flip Inc. for the financial year 22-23. The broad terms of EULA between the two companies are as follows. Grant of license. Flip Inc. grants MNO Limited a limited. So Flip Inc. students has granted MNO Limited a limited non-exclusive license to install, use, access, display and run the click-wrapped web-based computer software on a single local hard disk or other permanent storage media of one computer, so that you cannot make any number of copies out of it. MNO Limited should not make CWCS available over a network where it could use multiple computers, so that number of copies is not something which is allowed at your end. Reservation of rights and ownership. Flip Inc. reserve all right not expressly. Flip Inc. students reserves all rights not expressly granted to MNO Limited in this EULA. So obviously not reserves all the rights, students, in this context. Not expressly granted to MNO Limited in this ULA. But in my case, did I give all the rights to Bharat Law House? Answer is yes. Because I have transferred the copyright itself. Ritvik, the CWCS is protected by copyright and other intellectual property laws and treaties. Fine. Flip Inc. owns the title. That is, the title is owned by this. Owns the title, copyright and other intellectual property rights in CWCS. The CWCS is licensed only for use and not for any other purpose which cannot be sold. So the license which you have got from Bharat Law House is only for use. Flip Inc. does not have any offices outside country X. So it does not have a P outside country X. Extract of Article 12 of India and country X DTAA. Students, royalty and FTS arising in a contracting state and paid to a resident to the other contracting state may be taxed in the other state. Other state means the source country. So the source country, which is the other state, primarily, that country can also tax royalty and FTS, but provided the consideration could be characterized as a royalty and FTS, only then the source state will have the right to tax the same. Point number 2. However, such royalty and FTS may also be taxed in the contracting state in which it I have just said opposite. The first case, student, is about what? Paid to the resident of the other state. So first is, student, the country of resident. The first state, students, is the country of resident of the other state. That is what they have said. So the first case, the tax could be charged in the country of resident. What about the point number 2? However, such royalty and FTS for technical service may also be taxed in the contracting state in which it arises. So arise means the source state. So source state can also tax according to the laws of that contracting state, which in our example is India. But if the recipient is a beneficial owner of royalty, the tax charge would be maximum is 10%. So what they are saying is that the maximum rate of tax in the source country where this royalty would arise could be taxed only at the rate of 10%. In fact, our 115A is also talking about 10% only. But for that, students, the first and the foremost thing is that the consideration which you have paid could be characterized as a royalty. Only when the consideration that you have paid could be characterized as a royalty, that there could be the tax at the rate of 10%. That there could be, students, the tax at the rate of 10%. Isn't it? Now, please see the definition of royalty which you would have seen. The royalty definition, students, is about what? Consideration for use or right to use for copyright or copyrighted article. Students, is it for copyright or copyrighted article? It is for copyright and not for the copyrighted article. So students, I am giving the copyright to whom? To Bharat Law House. So the consideration which I am getting is for the copyright. Bharat Law House is giving you the book, which is a standardized material, standardized software, which is what is given to you by Bharat Law House. So the consideration that you are paying is the consideration towards the copyrighted article. So here the definition of royalty as per article number 12 of double taxation avoidance agreement between India and country X says that royalty means the consideration for the transfer of copyright, not for copyrighted article. And therefore, students, in this case, as per the treaty, it cannot be considered as a royalty, and hence, if it cannot be considered as a royalty, it cannot be charged to tax as a royalty even under the act. It cannot be charged to tax even as a royalty under the act. The second particular point, students, is that in this case, it does not have any P in India. And because it does not have any physical presence in India, so therefore we can say that it does not have a business connection in India. We can say that it also does not have a business connection in India. In this particular context, one way we can say it does not have a business connection in India. And now therefore we will say that it may not be taxable at all under the Income Tax Act. Under the Income Tax Act. But what about the equalization levy? Whether the equalization levy, is it applicable? Answer is yes. The first condition that should be satisfied is that the consideration that you have paid, should not be characterized as royalty, because if it is characterized as royalty, equalization levy of 165 or 165A will fail. Equalization levy of 165 165A will fail. So definitely we have already concluded it will not be characterized as a royalty. Point number 2, which section will applicable, 165 or 165A? It is 165A. Why? Because the e-commerce operator Flip Inc. dot, he is maintaining the web-based platform through which he is providing either goods or services. Here is a case of providing the services. Why? Because he is providing the service of what? Service of end use license software, which could be used by the service recipient. Which could be used by whom? By the service recipient. And who is the service recipient in this case? MNO Limited, an Indian party. MNO Limited, an Indian party. And therefore we can say that in this, under section 165A, at the rate of 2% on the consideration amount will be required to be paid by whom? By Flip Inc. dot of country X. He will be required to pay the equalization levy. So now let's see, based on this, what are the various questions which are being there over here. Based on the facts of the above case study, choose the most appropriate answer to question 1 to 4 below. Is MNO Limited India required to deduct income tax at source on the payment made to Flip Inc. dot? So tell me one thing, will it be charged to income tax? Please understand, this will not be charged to income tax, because we just now concluded that this is not in the nature of royalty. By applying the treaty, it will not be considered as a royalty, and because it cannot be considered as a royalty, therefore it is not chargeable under the act. Under the act, Income Tax Act, it now cannot be chargeable because the treaty is more beneficial as compared to the Income Tax Act, so therefore it cannot be chargeable. If it cannot be chargeable, therefore whether the payer who is making the payment of the amount, will he be deducting the TDS? Answer is no. He shall not be deducting the TDS. So therefore the answer over here, students, will be that no TDS will be required to be deducted. So therefore, students, this is the point which has to be considered over here. Point number 2, is equalization levy attracted in respect of the consideration received by Flip Inc. dot country X from MNO Limited? If so, what? If so, in whose hands and at what rate? So I told you, whether it will be an equalization levy of 165 or 165A, it has to be the equalization levy of section 165A. And that being the case, it is a 2% of the consideration. It is a 2% of the consideration amount for which the equalization levy has to be paid by this e-commerce operator Flip Inc. dot. Let's have a look. Would MNO Limited India be required to deduct tax at source? Over here, students, would MNO Limited India be required to deduct tax at source on the payment made to Flip Inc. dot if there was no DTAA between India and country X? If so, What amount of tax is required to be deducted at source on the said payment, students? Quickly, students, I'll give you 30 seconds to get the answer for the same. 30 seconds to get the answer for the same, students. So whether the TDS, students, will it be required to be deducted? Answer is yes. And students, by the way, what would be the rate of TDS in this particular case? The rate of TDS consideration would be in the form of royalty. What is the amount, by the way? I have not seen the amount, students. 5.7 crores. Students, here TDS part, one thing I should tell you, one thing. Just don't make the mistake, because these are the MCQ questions. You have to be extremely careful. Whenever it comes to TDS, students, always keep one point in mind. Whatever is the rate of TDS, on that particular rate, students, you will have to check the applicability of surcharge. Surcharge is subjective. Surcharge, students, will be subjective depending upon whether the amount that you have paid has exceeded the threshold limit. Now here the payee is a foreign company, and for a foreign company the threshold limit is 1 crore. If it is 1 crore or above, it is 2%, and if it is 10 crores or above, it is 5%. So that will be the rate of surcharge. Now here the fact is very clear that the amount of consideration is 5 crores plus, so to more than 1 crore. So in that case, the loading of surcharge will be applicable in this case. The loading of surcharge would be applicable in this case. And the next one is about the HEC. HEC always would be loaded at 4%. HEC always would be loaded at 4%, students. And that exactly is the point. HEC always would be loaded at 4%. Whether surcharge is may or may not, depending upon whether the consideration that you have paid is exceeding the threshold limit or not. Isn't it? That will decide the applicability of surcharge, but HEC, students, always would be there. So this loading of HEC or the surcharge, as the case may be, is to be considered only when the recipient of the income or the payee is a non-resident or a foreign company. Then in those particular cases, the loading is compulsory. The loading is not only for the TDS rate, the loading is also of the TCS rate. Even in the case of TCS, when you, in fact, the TCS is there, in that case also, there is a loading in the TCS rate of the surcharge and the HEC, as the case may be. So students, what is the answer then in that case? All of you students, in this context? Answer is C. Perfect, students. Answer would be C, students. And that exactly is the point. That exactly is the point, students. Now let's come to point number 4. Point number 4, students. Is equalization levy attracted in respect of? Is equalization levy attracted, students, in respect of consideration? Piyusha, how you got that? Is point number 4. Is equalization levy attracted in respect of the consideration received by flip inc dot country flip inc dot country X from MNO Limited if there is no DTAA between India and country X? So if there is no DTAA, students, in that particular case, obviously then it is a royalty. It is a royalty. And if it is a royalty, whether in that case equalization levy, will it be attracted? Answer is no. Answer is no, students. And that exactly is the point, students. The same MCQ type of question, students, in a different thing they have given in the form of no, Piyusha. The same MCQ question, students, in a different particular case, they have given you in the form of what? In the form of this. That is a descriptive question. So we have done once. I am not going to repeat again. But when I release the solution set, students, in that solution set, you will find even that particular solution. You can just read it once and that should be all. Let's come to question number 37, students. In this particular context. Now this is all about the DTAA, students. The double taxation avoidance agreement. Now you all are aware, students, so far as the DTAA is concerned, what happens in this case, students? Couple of important points I should just tell to all of you. Number 1 is this, that students, it all depends upon the nature of questions which has been given to you in the examination. Sometimes the question which has been given to you is very comprehensive, and sometimes the question which has been given to you has got a limited information. Therefore, it all depends how you are supposed to commit. Like I can say that in the last attempt or the last attempt, the kind of question was a bit on a more comprehensive level. But in other attempts, unfortunately, the question is not that comprehensive. So let's prepare ourselves from all the eventualities in this regard. Let's do this. So question number 37, students. So first of all, students, please understand if a resident in India, if he is earning income from foreign country, if a resident in India, if he is earning income from the foreign country, then definitely being a resident in India, that income is going to be taxed. And being the source country, even that foreign country will also charge tax on that foreign income. So therefore there is a double taxation. And when there is a double taxation, then the resident country to its resident, the resident country to its resident will have to provide the relief from the double taxation. The resident country to its resident will then have to provide the relief from the double taxation, students. The relief from the double taxation. So that relief from the double taxation, students, will have to be provided to whom? To this particular resident. To this particular resident. Now, in this case, we will provide the relief, but before we provide the relief, as I told you first, think of it, this particular foreign income, will it be taxed in the hands of the resident under the Income Tax Act? Answer is yes, because the world income is taxable. And therefore, this foreign income will form part of the total income. Therefore, this foreign income, students, will it form part of the total income? Answer is yes. So the foreign income will form part of the total income, and now the foreign income is denominated in foreign currency. The foreign income is denominated, students, in the foreign currency. Because it is denominated in the foreign currency, you need to convert the foreign income into INR. You need to convert the foreign income into INR. And how do you convert the foreign income into the INR? By applying the conversion factor. How do you, in fact, obviously it will form first part of your total income, and thereafter you will calculate tax liability on that total income, and from that tax liability you will then provide the relief from double taxation, isn't it? So first is the inclusion of the foreign income as a part of the total income. Now, as I told you, if the foreign income is denominated in foreign currency, in that particular case, students, we need to convert the foreign income denominated in foreign currency into INR. How do we convert that particular foreign income denominated in foreign currency into INR? So the way to do it is to apply the TT buying rate. Now please pay attention. If the foreign income denominated in foreign currency is in the nature of salary, or if it is in the nature of dividend, or if it is in the nature of interest on securities, or if it is in the nature of capital gains, then the TT buying rate for the purpose of conversion will be considered as on the last date, of the preceding month. Preceding to which month? The month in which these income became due or has accrued. The month in which these income has became due or has accrued. So you will go to the last month probably of this month, which with the month in which it became due or accrued, you will go to the preceding month, and of the preceding month you will go to the last date of the last date, whatever is the relevant TT buying rate, whatever is the relevant TT buying rate. On that rate you will do the conversion of the foreign income into the INR, and that foreign income into the INR will form part of your total income. That is the first thing that you should always keep in mind. But if supposedly there are any other income other than these four, like for example the house property income or the business income or other source income other than dividend and interest on security, then for all the remaining income, it is the TT buying rate on the last date is the conversion factor, that we need to apply on that foreign income so as to convert into INR, students. And that exactly is the point. Students. So students, over here, if you all will see very carefully what happens now in this context, let's have a look to this particular question then. Now, before I go to the question, so the foreign income is now forming a part of the total income. On the total income, you will calculate a tax liability. Tax liability you will calculate till HEC. And then from that tax liability, you will provide what? The double taxation relief. Now, the double taxation relief, students, how do you all provide a double taxation relief? This is how you do it. So you have to take up, students, the double taxation relief would be on the eligible amount, and on that amount you will apply the lower of the two rates. Which are the lower of the two rates? The foreign rate compared with the Indian rate, the IR I am writing it, whichever is lower. The foreign rate compared with the Indian rate. How you calculate the Indian rate? Indian rate is the tax liability till HEC divided by the total income, take the percentage. The tax liability till HEC divided by the total income, take the percentage. That is your Indian rate. Foreign rate, any case you will come to know, and therefore lower of the two is the eligible rate. Now this eligible rate, students, you will apply it on what? On the portion of the foreign income, which is subject to double taxation in both the countries, which is subject to what? Subject to double taxation in both the countries. So that portion of the foreign income which is subject to double taxation in both the countries, on that, students, you will apply on that is what you will apply, because obviously you are providing the double taxation relief. So it implies what? Only on that portion of the foreign income which is subject to double taxation in both the country, that is the qualifying amount on which you will apply the lower of the two rates, which is the Indian rate. Compare this with the foreign rate. The Indian rate, students, compare this with the foreign rate. Now, some of the unique examples, because this is where the students could go wrong. This is where the students can go wrong. Before I go to this point, students, let me in fact give you one more particular scenario. This relief that you calculate, students, always be careful. The relief that you calculate is country wise, because in some of the attempt they will give you, say you have earned the foreign income in more than one country, then please do ensure that whenever you provide the relief, you provide, say for country X, this is the foreign income of country X subject to double taxation in both the countries. On that, apply the lower of the two rates, the Indian rate, compare it with the foreign rate of country X, whichever is lower. Similarly, the second relief would be the foreign income earned in country Y subject to double taxation in both the country. On that, apply the lower of the falling rate. That is how you provide the relief. Please now pay attention to what I'm saying, because this type of question has not been asked. Sometimes, students, it may so happen that there is a possibility that within the same country, possibilities are there that you may have earned two source. There is a two source of income from that foreign country, and each of the source of income is charged to tax at a distinct rate with the other. Each source of income is charged to tax at a distinct rate as compared to the other. If this is what is the proposition, then in that particular case, what we do, then the foreign income, which is that particular foreign income tax in both the country, that much portion I will apply to the two rates, whichever is lower. Which rate? The Indian rate. Compare it with the applicable rate on that income in the foreign country. And again the similar exercise, that portion of the foreign income subject to tax in both the country, apply it with the Indian rate, compare this with the rate applicable on that income in the foreign country, whichever is lower. So this is also a possibility. However, up till now they have not targeted this sort of a question in the examination, but you have to be prepared for that. So up till now it has happened that, okay, there is only one foreign country, so only provide one singular rate that is applicable for all the income from that particular foreign country, for all the income which is from that particular foreign country. In which case I told you there is no such thing. What you need to do, that the foreign income from that foreign country which is subject to double taxation in both the country, you will take only that much of the portion, and on that much of the portion apply the eligible rate. And what is the eligible rate? Either the foreign rate or the Indian rate, whichever is lower. I hope that all of you are clear with this one, and that exactly is the point, students. Now in this context, I give you one example now. All of you just pay attention to this. I'll give you one example now. Students, say for example, from the foreign country I am getting a rent income. From the foreign country I am getting what? A rent income. Now in the foreign country there is no deduction of any expenditure on that rent income, because I have got my own house property in the foreign country. So therefore I am earning a rent income. So what the tax law of the foreign country does, on my gross amount of rent itself the tax is getting deducted, or it is getting paid. From the gross rent itself the tax is getting deducted, or it is getting paid. That is what is happening. Whereas as far as India is concerned, that rent income will, if it has to form part of the total income, you need to do the computation. That rent income, if it has to form part of the total income, you have to do the computation. Leave aside other deduction, at least one deduction you are going to give. And what is a deduction? The standard deduction. If the other information is also available, namely like municipal tax which is paid in the foreign country, then even that will be deducted. Interest on the borrowed capital or the loan which is taken for the purpose of purchase of that foreign house property, then even the interest deduction will be done in this case, isn't it? But leave aside those things, at least one deduction which is standard deduction. So 30% is the standard deduction, and the net amount is what will form part of the total income, and on that total income the tax liability would be calculated. So what happens now? My question to all of you therefore is, how much is the portion? How much is the portion of the foreign income which is charged to tax in both the country? It is only up to 70% in my example. Why? Because in that foreign country it is 100%. Whereas so far as India is concerned, it is only 70% because 30% you got deduction and only 70% is what is forming as a part of the total income on which the tax liability is calculated. On which the tax liability is calculated. The second particular path, students, in this particular case. The second particular path, students, in this particular case. Again, I give you one more example. There is one question which was there earlier asked, which used to say that in the foreign country you don't get any deduction of the losses. In the foreign country you don't get any deduction of the losses. That is what is the information, students, that you used to get. So the foreign losses which is in that country, no deduction or no set off. So therefore the question is to provide us that from the foreign country I have got, say, a income from one source of say rupees 5 lakhs and there is a loss from the other source of say rupees 1 lakh. But so far as the foreign country is concerned, the tax is on that entire 5 lakhs without setting off of the loss of 1 lakh. So the tax is on the entire 5 lakhs. But what happens now in India? The foreign income has to form part of the total income because the world income is taxable so far as this resident is concerned. So the foreign income will form part of the total income. How about the loss? The foreign law provides that no set off of loss would be available. But if I am computing my total income for this resident, then the computation of this total income has to be in the manner laid down under the Act. The computation of the total income has to be in the manner which is laid down under the Act. So therefore, the computation when I have to do, I have to then give the effect of the set off of losses. I have to give the effect of what? Of the set off of losses, unless under the Income Tax Act, these losses are also prohibited for set off. Unless these losses are also prohibited for set off, then that's a different story altogether. But if the question is silent, in that particular case, the set off of the loss, will have to be done. And if I do the set off of the loss, then what happens? My net foreign income will get reduced. My net foreign income will get reduced, forming a part of the total income on which the tax liability is calculated. How much is the net foreign income in the total income? 4 lakhs. The net foreign income after adjusting the set off of the loss, after adjusting the set off of the foreign loss, happens to be how much, students? Happens to be rupees 4 lakhs. So therefore now that 4 lakhs will form part of the total income on which you will calculate a tax liability till HEC, and thereafter you get the Indian rate. The tax liability till HEC divided by the total income, that will give you the Indian rate. Now this Indian rate, you will then compare it with what? With the foreign rate. Lower of the two will be the eligible rate. Now that eligible rate would be applied on what portion of the foreign income? That eligible rate will be applied on what portion of the foreign income, students? Indeed, that would be applied, students, on what portion of the foreign income, students? So students, as you can see in this particular context, 4 lakhs, students, 4 lakhs. Why 4 lakhs? Because that much is the only foreign income which is subject to double taxation in both the countries. 5 lakhs it was taxed in foreign country without the set off of losses. 5 lakhs is what was taxable in foreign country without set off of losses. What about in India? How much portion of the foreign income got finally taxable in India? It is how much, students? It is rupees 4 lakhs. So how much is the portion of the foreign income? Subject to double taxation in both the country? 4 lakhs. So on that 4 lakhs which is subject to double taxation, you have to give the relief. Relief would be the 4 lakhs into the lower of the two rates. That is the amount of relief, and that exactly is the point. On that basis, students, let's look upon to this particular question number 37. In this particular case, question number 37. Now, students, I want primarily all of you to also solve and practice on the sidelines. Solve and practice, students, on the sidelines also, students. That is important. Why is it so? Because this is the last opportunity now for you to even solve the questions like this. Last opportunity, students, is there. So, Mrs. Rajni, age 63 years, is married and settled, students. Is married and settled in Ranchi. She is a Hindustani classical dancer and choreographer who performs in concert in India and country M. She visits country M every year in October to participate in the spring dance concert held there. For the rest of the year, she performs in dance programs organized in India. India does not have DTAA with country M. India does not have DTAA with country M, students. In this context, and therefore in this context, the relief, if you know the section number, the relief is under section 91. Students, the relief is under section 91. Now, going forward, students, she earns 10,120 from concert held in country M. Obviously, it is in foreign currency. Now, obviously, if it is a foreign currency, we need to know the conversion factor, isn't it? Many a times, now this is the professional income. For professional income, students, what is the conversion factor? Of which date would be applied? Conversion factor of which date would be applied for the professional income? It has to be the TT buying rate as on the last date of the previous year. The TT buying rate as on the last day of the previous year, and that is the conversion factor that will be applied. So she earns CMD 10,120 from concert held in country M. She also owns a residential house property in country M. She earns rental income of CMD 25,000 from such property. Okay. So now tell me, in this case, so obviously this also would be converted, because in this case, last day of the previous year, conversion factor. She also paid municipal tax of CMD 200 in respect of this property, which is not deductible in country M. So not deductible there, but is it deductible here? Answer is yes. And apart from that, she also will get standard deduction on the net annual value. All the income from country M is taxable at the rate of 20%. So there are two incomes, two sources are there. So 20%. So can I consolidate the net foreign income forming a part of the total income and thereafter provide the relief? Can I consolidate the net foreign income forming a part of the total income on which shall I provide the relief? And the answer is yes, I can do that. I can do that, students, for the simple reason that because the rate of tax is the same. The entire tax due in country M has duly been paid by Mrs. Rajni. She earns rupees 15 lakhs from performance in dance program held in India. That is the Indian income. She has interest income of rupees 4.2 lakhs from the bank FD in her name. Students, bank FD in her name. What is the implication? Remember that she is a senior citizen, and the senior citizen who is earning the interest on bank FD, they are getting a deduction under 80 TTB. 80 TTB, and the rate, the deduction is maximum 50,000 rupees. So definitely, students, she is going to get deduction in this regard, in this context. So 50,000 rupees, students, that is going to get deduction, and that exactly is the point. Now, by the way, students, 80 TTB for senior citizen is for both. One is the FD as well as for the savings, whereas 80 TTA, students, 80 TTA is only for the savings other than senior citizen, is only for savings other than senior citizen, isn't it? So that is TTA. So TTB, students, she has an interest from FD 4.2 lakhs from bank FD in her name and 15,000 from the saving bank account. So obviously she will be getting, both are eligible, but the limit is only 50,000. Now, she pays medical insurance premium of 29,000 to ensure her health and 32,000 to ensure the health of her husband, who is also senior citizen. Senior citizen limit, students, it is 50,000. 50,000 limit is there for senior citizen. So for herself and for husband, both of which combined limit is 50,000. So she will get 50,000 as the deduction from ATD. She deposit 1.5 lakhs from PPF and 4 lakhs in 5 years FD in the name of her son. By the way, students, 5 years FD if you make, for that also you get deduction under ATC. ATC deduction is available even for 5 years FD. So therefore 4 lakhs plus 1.5 lakhs. How much is the total? 5.5 lakhs. Out of 5.5 lakhs, ATC would be 1.5 lakhs, and therefore the net would be 4 lakhs. The net would be 4 lakhs. So therefore 4 lakhs is what would be taxable in this context. So only 1.5 lakhs maximum is what would be allowed. So that is it, students. Compute the total income and the tax liability, students, which would be there, and that exactly it is. So students, this is what it would be in this regard. So students, please solve the question now, all of you. Now, when we meet tomorrow, students, in that 2 to 5 session, in tomorrow also, I think now I've already created the base. We will wrap up easily. In this case, the balance NR and the transfer pricing as well. Balance NR and the transfer pricing as well, students, in the next tomorrow's 2 to 5 session. So students, see you then tomorrow 2 to 5, students, in this context. The in the morning, students, PGBP. The morning class, students, would be of PGBP. That we will have it, but 10 o'clock, students. The timings would be at 10 o'clock. So first would be PGBP, then 2 to 5 we'll have this particular the Super 60, and then the evening, students, at 10 o'clock at night we will have again 10 o'clock at night we will have again this particular students assessment procedure. That is what, students, for the tomorrow's plan I've told to all of you. In that particular case, you then, students,